out your receivables and collect cash from them, because receivable means realizable. So you want to go there and realize your cash. Let's say you sold goods with the credit terms of 90 days. So you'll have accounts receivable. So accounts receivable to sales. So you have accounts receivable and sales. After 90 days, you will go to your receivables and collect the cash. So accounts receivable, this is going to get converted to cash. Now the question is, do you have the patience to wait for 90 long days, looking at the calendar every other day, and then go to your receivables and collect the cash? Or do you urgently need the cash? You want to see the money. So here you have a lot of options. You could transfer your financial assets, accounts receivable, notes receivable. You can transfer your financial assets. You could do, let's say, pledging. So you could pledge your accounts receivable with a financial institution. So you go with your accounts receivable, go to a bank and tell them you need a loan. So you're going to pledge it with them, take a loan from them. So you're going to have accounts, that's still your accounts receivable, remains here. Along with that, you have a liability loan, bank loan coming in here, and your cash increases because that loan gives you cash. Now, if you default on the loan, the bank is going to go to your receivables and collect the cash. So if you don't default, if you're remaining current on your loans, you're all good, then your receivables are yours, you keep collecting the money and you pay bank from the normal business operations. Whenever you feel you have enough cash or whenever it's due, you pay to them. Option number 2, you could assign your accounts receivable to a financial institution. In that case, what happens is, again, it's a loan that you're taking, but you tell them that whatever money I get from my receivables, I'm going to give it to you. So in case of pledging, you said whatever money you get from your business operations, you're going to pay as per the contract terms, as per the debt terms. In case of assigning, you said whatever money I'm getting from the accounts receivable, I'm going to use it to repay the loan that I'm taking. The third option that you have is, so the option number 1 and option number 2, pledging and assigning, were basically borrowings. So you used your accounts receivables to borrow money from a financial institution. Third option that you have is to sell this accounts receivable. You say, no, I don't like this on my balance sheet here, take it. Who takes it? A factor. This is called factoring of accounts receivable. You sell this off. So accounts receivable goes off your balance sheet and you get in cash. Guys, think about it. Anyways, after 90 days, you would have gone to your receivables, collected the cash, but you didn't have the patience to wait. You wanted to see the money so soon. You took it off, sold it to a factor, got the cash. So accounts receivable, instead of taking 90 days to get converted to cash, got converted the very next day. This is called factoring. So we're looking at factoring, assigning and pledging out here. These are transfers of financial assets like receivables. So let's look at factoring first. Now, in case of factoring, as I told you, it's a sale of your accounts receivable. It's getting off your balance sheet. It's no longer here then. It's off, disappeared, and cash came in. So this is a sale of accounts receivable. Now, in case of factoring, you're going to surrender the control. It's not on your balance sheet. That means you no longer have rights to collect the accounts receivable. It's off here. So these are off. They're no longer yours. You've sold it. You have surrendered control. Control is surrendered. Now, you could do a factoring with recourse or without recourse. Let's first look at without recourse. So, factoring without recourse, that means on your accounts receivable, if there are any bad debts, if some of your accounts receivable, some of your customers, debtors refuse to pay, the factor cannot come back to you and take it back from you. So the factor does not have any recourse. So the factor would have to bear the risk of bad debts. Once again, you're selling off your accounts receivable solely to a factor. By any chance there are bad debts on those accounts receivable, it's the factor's problem, not your problem, because the factor does not have recourse to come back to you without recourse. So that's factoring without recourse. So now in this case, you understand you don't have any continuing involvement in this. It's something like you sold it, forget it, not your problem anymore. No continuing involvement. And the second point that I would have here is the factor would bear the risk of bad debts. Factor bears risk of bad debts. And generally, the factor would charge a higher percentage fee for this, right? Because he's bearing your risk. He's going to charge you a higher percentage fee. Now, you could also sell it to a factor with recourse. So with recourse, let me create a little bit more space here we'll need for journal entries. So with recourse, so in that case what happens is, though your accounts receivable, you've pulled it out from here, sold it to the factor has given you the cash, but the factor tells you in case there are any bad debts, he'll be back, he'll come back to take that cash. So he is not ready to bear the risk of bad debts. He has recourse to you if in case of any bad debts. So in this case, you would say, though you've sold it, you sold your accounts receivable, you still have continuing involvement. In this case, factor both the risk of loss by bad debts. In this case, factor has recourse if there is a bad debt. That's with recourse, right? So factor has, the word is recourse for bad debts. Higher percentage fee, generally because you would say the factor is going to come back to you for any bad debts, you would want to give them a slightly lower percentage fees. So this is factoring sale of accounts receivable when control is surrendered. Let's now also look at assigning and pledging that we talked about. So let's move on with the board. Factoring, I'm also going to look at assigning. I'm using the entire board here, and I'm going to look at pledging. So assigning, as I told you, is a loan on accounts receivable or a borrowing on accounts receivable. Borrowing on AR, this is also a borrowing on AR. Now the difference between assigning and pledging. So when you assign, you say you're going to repay this borrowing with all the cash that you receive from your receivables to be repaid from cash received from AR. Now in this case, pledging, this is again a borrowing, but what you would say, the moment you get a cash from a customer, you could use it to pay your salaries, your rents, and you could pay back the money as per the contract, the debt terms. So you're going to use, this is a borrowing, you're going to use the cash from accounts receivable for your operations, and whenever you need to pay as per the debt terms, you're going to be paying it. So borrowing on accounts receivable, where you repay the loan using entities cash, not necessarily cash received from AR, from entities business operations. Borrowing on AR to be repaid from entities cash. Now as a matter of fact, most of your cash might come in from your accounts receivable, so you're still using the money coming in from receivables to pay the borrowing, but still in this case you could use that money for other purposes also. Here all the money that comes in from receivables goes straight to the bank, to the financial institution. So you could say in both these cases, control not surrendered. What is not? So in this case, the control, you still control your accounts receivable. It's still in your control. But in this case factoring, you've surrendered control. It's out of your control and in the factor's control. We look at that on the book. So it's out of your control and in the factor's control. Now we've looked at without recourse. So without recourse, generally as a general rule, whenever you're factoring without recourse, control is always surrendered. It's a sale. There might be cases when you're factoring with recourse and control is not surrendered. It's still in your control. In that case, it will not be accounted for as a sale. It will be accounted for as a borrowing. So it's a sale only when control is surrendered. So you could say, let me draw the arrow the other way. Control is surrendered, that means it's accounted for as a sale. In this case, control is not surrendered, so it's a borrowing. Control is not surrendered, so it's a borrowing. The key word here is control. On page 14, we are looking at transfers of financial assets. Highlight pledging, highlight secured borrowings. And on the second line, highlight only disclosure required. Next, highlight assigning, highlight agreeing to use the proceeds from the asset to pay the loan. Then highlight factoring and highlight selling to a factor. So now you sell the receivables for cash to a factor. Now the sale could be with or without recourse. For a sale with recourse, on the left right, factor has recourse in case of bad debts. For sale without recourse, make a note which says factor has no recourse and bears the risk of bad debts. So if it was a sale with recourse, the factor had recourse. If it's a sale without recourse, the factor has no recourse. Now the next bullet, we're looking at accounting for transfers of financial assets, and we use highlight financial components approach. So it says the transfer may be accounted for as a highlight sale when control is surrendered, or borrowing when secured loan with control not surrendered. It says sale or surrender of control is when all of the following conditions are met. Number one, transferred assets are isolated and beyond the reach of the transferor and its creditors, even in bankruptcy. Number two, transferor does not maintain effective control, may not have a repurchase or redemption agreement. So basically what it means is, put a bracket and write out of my control. The third one, it says transferee can pledge or exchange assets without unreasonable constraints or conditions. Now put a bracket and write in your control. So it's a sale or surrender of control when the financial assets are out of my control and in your control. Moving on to page 15, we are looking at transfers which may be accounted for as a sale when control is surrendered, or as a borrowing when control is not surrendered. So the first column there, factoring without recourse, highlight control surrendered, highlight sale, and highlight no recourse. The second column looks at factoring with recourse when control is surrendered. So highlight control surrendered, highlight sale, and highlight factor has recourse. Now in the third column, we're looking at pledging or assigning or even factoring with recourse when control is not surrendered. So circle the not, and it's recorded as underlined borrowing. Now let's look at an example to understand more about factoring of receivables. As I told you, this is the selling of accounts receivable. Take it out of your books, sell it. Where you surrender your control, it's out of your control and it's in the factor's control. Now it could be without recourse or with recourse. We'll first look at an example on without recourse, then we'll talk about with recourse. Now let's look at the example here. It says small company enters into an agreement with Big Corp on 1st July 2010 to sell a group of its receivables with face value $400,000 without recourse. So the face value of the receivables is $400,000. So it's selling it to taking it off its balance sheet, selling it to a factor without recourse, where there's no continuing involvement. The factor would bear the risk of bad debts, and naturally the factor would charge a higher fee. So let's look at it. Big, the factor charges 25% interest computed on the weighted average time to maturity of the receivables of 36 days plus a 6.75% fee and retains 5% holdback. So there are three items here. First item, interest. Now this receivables which the company is taking off and selling it to the factor, these are not due immediately. There might be some receivables which are due in the next 1 week, some receivables due in 15 days, some receivables in 30 days, others in 60 days, 75, 90 days. Now what the factor has done is he's calculated a weighted average time to maturity. He says on a weighted average basis, all these receivables mature in 36s, or rather they are due in 36 days. So what he would do is he would calculate an interest expense for that particular time period, which he would charge because you're selling it off. He's bearing that interest for that. So the interest rate in this problem is 25% for those 36 days. Now apart from that interest, he is naturally charging a fee for the service he's doing. He's taking it from us and he's going to be collecting it. Plus he is going to also bear the risk of bad debts. So he's taking a fee for the service and for the risk of bad debts. Now you have something called a 5% holdback on this problem. We said the factor, he's taking the risk of bad debts. But what if there are certain sale returns from the receivables? How did we generate the receivables? Because we made sales to them. If they have something which they're not using or something which is rejected, they're going to return it back. So that is of no use to the factor. He is not going to bear the risk of sale returns or sale discounts. He is only bearing the risk of bad debts. So what he does is, instead of paying us the entire amount of cash, remaining cash upfront, he is going to retain some cash with him. So that's called a factor's holdback or due from factor. In case there are no sale returns, no sale discounts, in that case the factor would return back the entire amount of cash he has held back, or the factor's holdback is going to come to us later. That's why it's called due from factor. So let's try solving this with a journal entry, and this is going to get easier for us. Here's accounts receivable. We are taking it, strapping it from here, selling it off to the factor. So you have accounts receivable, which would be a credit. So accounts receivable debit balance no longer existent. So entire 400 goes off. Now, in return for doing this, factor is giving us cash. We're going to calculate how much of cash. He's not going to give us the entire $400,000 of cash. He's going to be giving us something lesser than that. So he's going to retain a holdback. So you have factor's holdback, which you also called due from factor. And in this problem, that is 5%. So 5% of $400,000, that's $20,000. Plus there is some, so this is a receivable now. So we had a receivable of 400 which is going off. Instead of that, we are having another receivable from the factor, due from factor, 20,000 bucks. Now the factor naturally is going to have an interest expense, is going to charge us for the interest, the time gap, plus a fee. So all that could be loss from factoring, which would include the interest expense and the factor's fee. So interest expense in this case is 25%, and the weighted average time to maturity of all these receivables is 36 days. So $400,000 into 25%, that gives us $100,000 for the entire year. For 36 days out of 360 days, that calculates to $10,000. So interest expense is $10,000. Factor's fee is 6.75% of this, which calculates to $27,000. So what you could say is the loss from factoring, the expense that goes into your income statement, that's a non-operating item. The expense that goes into your income statements, that's $37,000. It's interest and the factor's fee. The factors holdback, which is again a receivable, which is an asset on your balance sheet, that's $20,000. Now, what is remaining? How much cash do we get? That's the plug. So our plug is 400 minus 37 minus 20, which calculates to 343. This is the amount of cash which the factor is going to give to us. So we've converted $400,000 of receivables into $343,000 of cash, with $20,000 due from factor, hold back by the factor, to be coming in from the factor later. Let's say there are no sale returns, no sale discounts. In that case, later, after a specified period, the factor is going to give us this $20,000 also in cash. So the cash would increase from 343 to 363. So we've sold $400,000 worth of receivables for $363,000. And we've had $37,000 of loss from factoring. Simple and easy. Now, let's look at this problem further. It says past journal entries: if small customers return $7,100 of merchandise on 31st July, further the customer return privilege expires on 30th September and the remaining holdback is paid to small. So there is, out of this $20,000, there is a $7,100 of sale returns. So that $7,100 would end up being in sale return out of here, reducing our sales, and the remaining $12,900 comes in as cash. So if there were no sale returns, the entire $20,000 would have come in. Because there are some sale returns, the factor reduces from his holdback, because the customers, the accounts receivable, they are not going to pay for goods that they return. So guys, I'm sure you're getting this. We're looking at loss, we're looking at factors holdback, due from factor, sale returns, sale discounts. We're looking at loss from factoring. This is interest expense for the time gap and the factors fee. Now, because it is without recourse, the factors fee also includes the risk that the factor is bearing for bad debts. That's why the fees is pretty high. Now let's look at the next problem. So you have, this time we're looking at factoring with recourse. So you got the same facts, and here small company enters into agreement to sell its receivables with $400,000, this time with recourse. Big charges 25% interest computed on the weighted average time to maturity of the receivables of 36 days plus a 3% fee and retains 5% holdback. So this fee was 6.75%. Now the factor, because it's with recourse, he's charging a lower fee, just 3%. So in this case, we're going to have a similar journal entry. So we're going to be getting in cash. There is some factors holdback, due from factor. Again, there's loss from factoring, and this would include the interest expense and the factors fee. And what is going off is accounts receivable. This factors fee does not include the risk for bad debts, because in case there are bad debts, the factor has recourse. He can come back to us. So let's pass the journal entries out here. You have accounts receivable going off of $400,000. Loss from factoring, the interest expense is still 25%, so same amount. The fee has come down. The fee now is only 3%. The fee is only $12,000. So this is 22. Factors holdback, it's still 5%. So this remains at 20. So 400 minus 22 minus 20 minus 42, that gives us 358 of cash coming in. But guys, the difference here is bad debts, recourse for bad debts. So now, by any chance, if there are any bad debts, we've sold off the receivables, but we still have continuing involvement. If there are any bad debts, the factor, he's going to come back and take away the cash from us. So what we would do is, similar to the allowance that we used to create, we would create a liability which we call recourse obligation. Because the factor has a recourse, we have a contingent liability, we have a recourse obligation. If any of our debtors, customers, the receivables that we are selling, they refuse to pay to the factor is going to come to us, collect the cash from us. So that's a contingent liability that we have, and that we would add it to the loss from factoring. So what we would do is we would debit loss from factoring, and this is for bad debts, or rather for estimated bad debts, and we would create a liability on our balance sheet which we call recourse obligation. And let us say in this problem the recourse obligation, say small's recourse obligation, this one has a fair value of $15,000. So guys, let's compare these two. Receivables went off 400, same number went off. Factors holdback 20,000, same number. Loss from factoring, the interest expense was the same number. Factors fee was higher here, $27,000. It was lower here, only $12,000. Why was it lower? Because the factor has recourse for bad debts. But though the factor's fee was lower, we had a recourse obligation. We had a $15,000 expense. Why? Because that was a contingent liability. So ultimately, more or less, it came to the same amount. It was $27,000 here, and the numbers have been made in such a way that it's $27,000 here. So guys, it's for you to understand that though the factors fee is higher and lower, there is an additional recourse obligation, an additional journal entry that you're passing for your recourse obligation, which brings up, rather pushes up your loss from factoring. More or less comes to the same amount. Just that in the second case with recourse, the cash received became more. So cash received, instead of 343, you got a cash of 358 out here. And you had a recourse obligation out here for 15,000. So that's the cash here, the second journal entry. This is very important and you got to remember this. Now this is accounting in case of factoring, when you're selling, taking it off, selling it, surrendering control. Let's also look at journal entries for assigning and pledging, where you're actually borrowing on your accounts receivable and not surrendering control. So in this case, let's look at pledging first. So in this case, what's coming in? Cash. And you will have to pay some interest here, and let's say notes payable or debt. So that is basically you've pledged your accounts receivable. It could be notes payable, it could be debt, bank loan. Now, if it's assigned, similar thing, right? So you have cash, interest, notes payable. But what do you do? Because accounts receivable are no longer yours. Guys, think about it. The accounts receivable, whatever you get cash from your accounts receivable in case of assigning, you have to give it off. So though the accounts receivable are still on your books, whatever money you get, you're going to give it off. So what you do is you create an account called accounts receivable assigned, and you take off accounts receivable just to make sure there's proper disclosure. It's still accounts receivable, just that you're making sure there's proper disclosure on the face of the financial statements that these accounts receivables, they are assigned. Though you may be collecting cash from those receivables, you have to give all the cash that you collect to the financial institution you've taken the loan from. So guys, that is about factoring versus assigning versus pledging. Let's look at the journal entries and the example that we did on factoring on a book now. Now let's get back again to page 15 and look at the last row of the table that we have there to understand the journal entries for different kinds of transfers. And on these journal entries, let's try to put in numbers from the next page, page 16, so as to enhance our understanding of the accounting that we've got here. So for factoring without recourse, you got a debit to cash, factors holdback, loss from factoring. The credit, that's to accounts receivable. So for cash, right, 343. Factors holdback, that is 20. Loss from factoring, that calculates to 37. The accounts receivable that is going off the transferor's books, that's 400. Below this column, right, interest is equal to $10. Fee, and within bracket, right, higher is equal to $27. Total loss is equal to $37. Now looking at the journal entry for factoring with recourse, cash comes in, right, 358. Factors holdback, that is 20. Loss from factoring, that's 22. accounts receivable going off the books, right, 400. Now, since the factor has recourse, the transferor now builds up a recourse liability. So the next journal entry there, loss from factoring, right, 15. Recourse liability, that's again 15. Make notes now. Interest is equal to $10. Fee within bracket lower is equal to $12. Recourse liability is equal to $15. Total loss, that again calculates to $37. So guys, we've built this example in such a way that the total loss for factoring without recourse and factoring with recourse comes at more or less the same level. But what I want to highlight here is, in case of a factoring without recourse, the fee is higher than factoring with recourse, because in case of a factoring without recourse, the factor has no recourse. The factor bears the risk of uncollectibles. In case of factoring with recourse, the factor has recourse. He can come back if there are uncollectibles. And that is why the transferor has to build up a recourse liability, which increases the loss from factoring. Now, the third column there, where we're looking at pledging, assigning, factoring with recourse, where the control is not surrendered. Now, this one needs to be recorded as a borrowing. So it's cash coming in, interest expense, credit to notes payable. Look at the next journal entry. Accounts receivable assigned debit, accounts receivable credit. Now, this is only in case of assigning. So put an arrow there and write if AR is assigned. Now let's understand a few terminologies that we have on these concepts regarding transfers of receivables. Highlight factors holdback due from factor. Now this is the factor's retainer for underlying sales discounts, underlying sales returns. So this amount would be returned by the factor if there are no deductions by the accounts receivables. Next one, highlight loss from factoring. So we've seen the calculations above. We've written that down on this page. So loss from factoring is the factor's fee plus interest plus any recourse liability if it's factored with recourse. Next one, highlight recourse liability. Now this is an estimated allowance for underlying bad debts. Moving on to page 16, we got a couple of examples on this page which we've done in pretty much detail, and we've also put numbers from these examples onto the previous page. Now, I want you to get to the bottom of this page and look at the second example that we have on transfer of receivables with recourse. Look at the last journal entry there, which says loss on sale of receivables, or the loss on factoring debit, and the credit is to recourse obligation. Draw an arrow from that and write, since factor has recourse in case of bad debts, a recourse liability is estimated by the transferor. Once again, since factor has recourse in the case of bad debts, a recourse liability is estimated by the transferor. Now, we've looked at transfer of receivables. So we could pledge and assign these receivables. That's like a borrowing based on these receivables. We could also sell it to a factor. So factoring was taking it off, selling it to a factor and collecting cash in return. So converting them into cash. Another very innovative way of transferring receivables is securitization. So securitization is basically transforming these receivables, financial assets, into securities. They become asset-backed securities. Now think about it. Think about it as a balance sheet of a financial institution. Now they're going to have a lot of receivables here, a lot of assets, Let's say mortgages, they've lent out money for mortgages, they've lent out money for credit cards, they have loans, leases. So what they could do is they could pool these assets together and create securities, where these assets serve as collateral for those securities that they would issue out to investors. Hence, those securities which are issued out are also called collateralized debt obligations, or CDOs. Now, let's talk about mortgage-backed securities. So, CDOs based on mortgages. So, the bank has receivables from mortgages and it can securitize that and issue mortgage-backed securities. Now, guys, as you all know, mortgage-backed securities that led to the subprime crisis, the global financial crisis in 2007. So let's talk about that, and with that concept, we'll also understand a lot more about securitization. So let us say in the mortgage market, you have a mortgage lender. Now this institution lends out money to homeowners to enable them to buy their houses. So a lot of houses across the US. So you have all the houses. Wow. Quite many houses, yeah. One more. Look good. So the mortgage lender has given out loans to all these house owners to enable them to buy houses. Now, the mortgage lender has a lot of receivables on his balance sheet. Now suddenly he gets a call from a very smart investment banker in Wall Street. So this Wall Street guy, he calls up the mortgage lender and tells him, give me all your receivables. Give me all the mortgages that you've lent out. In return, the mortgage lender gets a fee. Why? Because he's done all the effort of lending out money. Now all these receivables are transferred to the investment banker. Now what the investment banker does is he takes all those receivables, all those mortgage loans, puts them together, bundles them together and creates securities. So what he does is he creates three tranches, three levels, rather three slices, let's say. The first slice you could say is safe. The second slice is okay. The third slice is risky. Basically what he's done is he's put all these mortgages in this box. Now from those mortgages, think about it, the money has been lent to the house owners. Now house owners would be paying their installments every month, they would be paying principal and interest. So all that money that comes in, that's the cash flow coming in. So using that cash flows, they would be paying out to the investors of those securities. So you would have investors to all securities, for safe securities, for okay securities, and for risky securities. What would happen is when cash inflows come, first you would pay out the safe securities, next the okay ones, and last is the risky one. Naturally, for the safe securities, you would have investors like pension funds, conservative investors. For okay, you would have other banks, financial institutions. For risky securities, again, you have hedge funds who are ready to take more risk. Naturally, if you're going for risky securities, you're going to get more return. So let's say the safe securities get like a 4% return. Okay ones get 7%. Risky one, they give them like 10%, even more. The safe securities, they had like AAA rating. Okay could have like BBB rating, and risky ones were, let's say, unrated, not even rated. So guys, as you realize, what they have done is all the cash inflows that this box would be getting from all those house owners, the money would be going on to the investors of the securities. Naturally, the safest investors, the investors investing in this safe tranche would get lesser return. Why? Because they would be the first ones to be getting in the money when the cash comes in. Then the okay ones, and finally risky ones. Now all this so far so good. It was all so nice. Now what happened is there was a lot of demand from these investors for these securities, these asset-backed securities. Now since this is residential, you could call them RMBS, residential mortgage-backed securities. So a lot of demand for them. You also had CMBS. So if the loans were to in the commercial sector, retail, offices, that was commercial mortgage-backed securities. So let's talk about RMBS. So there was a lot of demand from these investors to invest more because they were getting pretty good returns here. I mean, the Fed rates for treasuries, they were very low in the early 2000s. So this was good return. Now they wanted more. Now what happened is all those guys, all those homeowners who could afford a house, or basically who had income enough to afford a house, already had houses. So the market was like, they were not able to do a lot of stuff. Suddenly these investment bankers had an idea. What they did was, they said, instead of only lending out money to credit-worthy homeowners, how about we also give houses to people who can't afford houses, people who don't have enough income, people who don't even want to give a down payment to buy a house. Think about it. So these were all credit-worthy. Now they said, we're going to lend even to non-credit-worthy homeowners. Because what they said is, the assumption was the prices of houses will always go up. Look at this direction. It's always going up. That was their assumption, that the prices of houses always goes up. Even if we lend to non-credit-worthy customers, rather non-credit-worthy homeowners, and they default, we can take their houses and we'll make a good margin out of it. So there's no big issue there. So now what they did was, they started lending to homeowners. They didn't even have proper documentation, they didn't take any income proof, they didn't even ask for down payments. So everybody who didn't even afford a house now had a house. Now as you realize this non-credit worthy, now so you had all, let's say, subprime. So what happened is, when they lend out to non-credit worthy homeowners, the securities that were created, they were called subprime securities. They were not prime securities, they were subprime, because the quality was not so good. Guys, think about it. If the cash flows from these homeowners stop coming in, you can't pay anything to the investors. So that's why they were called subprime. Now even though they were subprime, the investment bankers got good credit ratings. I mean, they managed to get it from the credit rating agencies. They still got AAA, BBB. So it was still all good. So they were making a lot of money on this, and they had created a lot of trillions of dollars of subprime mortgages. Now, as you can expect, I mean, this was like a bomb which was waiting to explode. These guys who could never afford a house, just had a house, and who never wanted to pay back the loans that they had taken, started defaulting. So let's say you had a default starting from here. This guy says, I can't pay my mortgage, take back my house. House is there for foreclosure. So the banks go, take the house is up for sale. Another guy defaults. This house is now again up for sale. This guy defaults, up for sale. So you have another defaulter coming in. All these guys, they were not having enough income to afford a house, but they were just given loans and pestered into buying houses, and they were like very happy buying houses. But now they were not able to repay their interest, their principal on the mortgage loans. Now what happened is, with all these defaults having, there were a lot of houses getting available in the market, a lot of foreclosed houses. Guys, think of the demand supply scenario. Now there was huge amount of supply in the housing market. Demand was pretty low. That is why the housing bubble collapsed, it burst. So the prices of houses, as per the assumption which was supposed to go up, now started going down, because there was a lot of supply. Everybody started defaulting. Everybody was defaulting. Lot of houses up for sale. The prices of houses, the value of houses fell. Cash flows stopped coming in. These securities which were highly rated became downgraded. They lost their value. All these investors who had invested in these subprime securities started losing value. Now, even those prime lendings, for those prime lendings where the mortgage lenders had lent to credit-worthy customers. Now, what those credit-worthy customers thought was, let us say, I had a house which was worth $1 million and I had taken an $800,000 loan on that. Now, my house is worth only $600,000 and the loan stands at $800,000. I say, I better lose my house rather than paying $800,000 of mortgage loan in return for the $600,000 house. Guys, think about it. It was $1 million house where, so the house was $1 million, the loan was let's say $800,000 on that. Now the value of the house collapsed, bubble burst. The house was worth only 600. The loan remained at 800. Do I want to repay this loan, which is more than the value of the collateral, the house? I would better default. So then even those credit-worthy customers, credit-worthy homeowners, they started defaulting. That aggravated the crisis. So guys, as you can understand, not only subprime securities, even prime securities were getting hit now. Subprime securities, naturally, they were really badly hit. You don't have cash flows coming in. If you don't have cash flows coming in, you have nothing to pay these investors. Credit ratings start downgrading. The values of all the securities start falling. Guys, this is the subprime crisis. So you see securitization here. Securitization is basically all these mortgage loans, they were converted to securities. So all these were securities. Loans, so you have a few houses here, you have thousands and thousands of houses, and you have a lot of securities being created. So the financial asset was the loans made to the homeowners, the mortgage loans, which created these securities which were called mortgage-backed securities. So it was RMBS, residential mortgage-backed securities, CMBS, commercial mortgage. So that was for retail and office. And these are called CDO, collateralized debt obligations. Now, this is not so heavily tested on the CPA exams, but this was a good overview which helped us understand the subprime crisis, the global financial crisis which has hit a lot of us. On page 17, we are looking at transfers of financial assets via securitization. Now, in case of a securitization, what you do is highlight pool or group similar financial assets and then highlight transform them into securities with an established market. Now, the second bullet on this page talks about impairments of financial assets. Now, this was pretty widespread during the global financial crisis. So right there, if carrying value of financial asset is greater than the fair value of the financial asset, so that is when you could say the financial asset is impaired. Let's use the securitization model that we've built here to understand servicing of financial assets. So we have all these homeowners who've been given mortgage loans and the security holders of these mortgage-backed securities created by these investment bankers. Now you would need somebody in between here to make sure the payments collected in from these homeowners go to the security holders. So let us say the investment bankers, they create a servicing contract and they retain this servicing contract with themselves. So they say that, they would be responsible for collecting in payments from all these homeowners and giving it out to the security holders. They would pay any required taxes, insurance. They would monitor delinquencies by these homeowners. They would go out and foreclose houses if they don't pay. They would account for all the money coming in and going out. So for all this, naturally, they would charge a fee, $1 coming in for them. Now, generally what happens is this dollar, the fees that's coming in is more than the cost of servicing. This results in a servicing asset. Think about it. If let's say they have a servicing contract over the next 10 years and every year they're going to be getting fees, and the fees every year is going to be more than the cost incurred by them. So the net income each year or the next 10 years can be present value to current date, and that becomes an asset. So they could keep the servicing asset with them, or very smartly they could sell it off. So that becomes a servicing contract. It's an asset when the benefits are more than adequate compensation for the cost of servicing. If the benefits are less than adequate compensation, then it becomes a liability. Now, for this servicing contract, you will have two methods. Number one, it's the amortization method. So what you do is initially the servicing contract is recorded at fair value, and then it's amortized based on in proportion to the estimated net servicing income each period. Or you could also use the fair value method, where at the end of each period A fair value is calculated for the servicing contract and the value adjusted accordingly. Now, let's get on the book and look at an example. Rather, let's do an example on the board and then we'll go to the book, look at it in detail. So, you have an example on servicing of financial assets where it says Prime Company sells its loans with a book value of $16,000 and fair value 20,100. So, Prime Company, the banker or the financial institution, they had a loan of $16,000 book value, which had a fair value of 20,100. How can the fair value be more than book value? Maybe they had lent out money at very attractive interest rates such that the market is ready to pay 20,100 to buy their receivables. What they do is they sell it off. They sell it off for $18,000 cash. So they sell this for cash $18,000. And they create a servicing contract, rather I think they retain that servicing contract which has a fair value of $1,400. Look at that, servicing contract with fair value $1,400. Basically this is the value from expected fees, late charges, float and other income. So they also create a servicing contract which they keep with themselves worth $1,400. They also have an interest strip of 1% with fair value $700. So interest strip worth 700, 1% interest strip. So guys, what they're basically doing is they're selling off their receivables. But what they're doing is the receivables would be sold off, but they would still be responsible for collecting on those receivables. For that, they have retained a servicing contract with a fair value of 1,400. They've also retained an interest strip of 700. What it means is, of all the interest received, 1% of the interest, rather 1% interest will be stripped off and retained. Remaining would be passed on. So this is all the benefit that they're going to be getting. So 18,000 is the cash that they've received right now. This is the present value of all future benefits, rather the fair value of the servicing contract and of the interest strip. So in total, they've received 18,000 plus 1,400 plus 700. They've received 20,100. So they've received the fair value now. What has gone off their books? The loan receivable, that has gone off their books. And the loan receivable was at 16,000. And in total, the consideration that they've received is 20,100, which includes cash and the contract and the strip. So they have a gain on sale of the receivable of 4,100. The focus here was to understand the servicing contract, because in this case it looks like the fees coming in from the contract is more than adequate compensation, and that is why it is recognized as an asset. On page 18, we are looking at servicing of financial assets. Highlight separate servicing contract to service financial assets. Now, if the servicing contract provides more than adequate compensation, you would record highlight servicing asset at fair value. Now, you got an example on this page, and to help you understand the concept behind this example, make a note which says you take ownership of the receivable, but I'll still collect them for you for a fee. So they are my receivables. Now you take ownership of these receivables, but I'll still go out and collect them for you for a fee.